So we've been talking about the statement of owner's equity, and now we're going to show you how to build it. So here's your Excel file. You've got all of your other statements built, and I've again just left the formatting in here, but I'll show you how to put in the numbers. The first thing that we need to do is we've got one statement of owner's equity for every two balance sheets because it's looking at the change in owner's equity from the beginning to the end. So it's for the year ending December 31st, 2011. We've got one for the cost-based, one for the farm market-based, and then we've got one for the farm market combined with the personal market-based. Withdrawals for family living, you've got them in here as blue just because we could actually calculate them here and then use them on the statement of cash flows, or calculate them there and then use them here. You can get rid of the blue if you want. It's just a formula here, but I think it kind of just helps my mind remember that it's an issue. So the first thing we have is the beginning statement, beginning owner's equity. So a plus or an equals to tell it's a formula, and then we get that from the balance sheet. And here is the total owner's equity, the beginning for the cost, hit enter. For the market, same way, go over to the balance sheet. I've got to get the beginning market, so I want the 2010 farm market, so that's here in column D. Enter, and both. Plus or an equals does the same thing. This clicks me over so I can see those beginning sheets, balance sheet, and then my combined beginning. Net income, I'm going to get that off of the income statement. So plus or equals income statement. For this number here is for the farm and the family combined, and we only want the farm income. So click on this amount, but then is what we want to do is subtract from that the off-farm income and add back to it the personal taxes right down here that we deducted. And so this $34,266, that's just the farm's net income. Over here, we want to refer to the same number because this is both just the farm. But then for both, we want all of the net income because that's the farm and family combined. So we use both. Withdrawals for family living, we get that off of the cash flow statement. 14,680 for the farm. This is still a farm column, so we want the same number, just refer to it. And for both, we want the amount from the column for the farm and the family. Here's a spot that if we wanted to, we could put in change in contributed capital. If you've got an ongoing business, a lot of times this will be 0, and so you don't always see it on there, but here is a spot for it. And is what you're going to have to do is then you would really calculate it from the balance sheet as over here, balance sheet. Here's our contributed capital. And so to be the ending amount minus the beginning amount. And it's going to be the same amounts for there. A lot of times, like I said, we'll leave this off because it may be 0, but I just wanted to show you how to do it if you wanted to. So now our total change in contributed capital and retained earnings is going to be our net income. That increases our net retained earnings, minus what we withdraw, and then plus anything we contribute. And this change in contributed capital could actually be a negative number, so it could cause it to decrease. So we just add it, and so if it's positive, it's going to increase it. If it's negative, it'll decrease it. Just copy that formula over. So we've got, from operating our business, we increased our wealth by $19,586. For cost-based, that's the only source of our changes in wealth. And so our total change in owner's equity here is just plus whatever that change was. However, for market-based, for these columns, we've also got the change in the valuation, the appreciation of our assets. And so we've got to find our asset appreciation change in wealth. The way we do this is for each of our non-current assets that could have gone up in value, we want to look at how much did they go up in value. So over here we say plus or equals, click over on the balance sheet, come up to, here's the market value of our assets. So for raised breeding livestock, our market value at the ending minus the market value at the beginning, that tells us how much our market value is increased. However, we can't stop there, because the reality is that it should have gone up by $2,500. And so if it didn't do that, or if it went up by more, that is the market appreciation. So what we've got to do is subtract here, minus, opening parenthesis, the change in the book value, because that's going to capture what's happened because of purchases, sales, depreciation, because the change in market valuation really is not just how much the market value changed, but how much the assets appreciated in value. So this is the market value ending, change in market value ending minus beginning, minus the change in book value ending minus beginning, because however much of this change can be explained by purchases, sales, and depreciation is captured in this change in book value. And then hit enter. So in this case, our raised breeding livestock actually went down by $2,500. Because all of these are in the same order on the balance sheet, once I've got it for one, I just copy it down. And if you want to check to make sure that it's correct, sometimes it's nice to just say, look at one of these like land, and we have E31, D31, and so then click over on your balance sheet, and yes indeed land is on line 31, so it looks good. For the farm and family combined, these amounts are the same, so just refer to them. However, we only have market value of our personal assets. We don't have the book value and the market value, so we can't do the change in market value minus the other. And our personal assets also include the cash over in the balance sheet, so we've got to do this one by hand. And so what you're going to do here is take the ending, which is $162,000 for the house, plus $64,900 for the household goods, minus the beginning, $156,000 for the house, minus $66,500 for the household goods. And that shows that they actually went up in value by $4,400. However, we know that we purchased $4,500 of household goods, and so they should have gone up by $4,500. So what we do is we subtract also off our purchases, $4,500. And we would add to it the sales. If we had sales, we'd actually add to it. And again, we're doing these opposite signs because we're trying to explain how much the value increased because of market appreciation. And so if it should have gone up by $4,500, we're going to subtract off $4,500 because we can explain that much difference just because of our purchases. And so in this case, they actually went down by $100. So now our total change in market valuation is just the sum of those. And you want to make sure here that you've included this $100. And so these are $100 different. Now, because our market value has gone up, if we actually sold assets at that value, we'd have to pay taxes, and so we want to also account for how our taxes has changed. So it's the deferred taxes on non-current assets, and we click over on the balance sheet. Deferred tax on non-current assets is down in our liabilities, and it's non-current. So it's the ending minus the beginning. So our tax obligation has gone up by $7,845. Refer to that in the same column. And so our total change is how much our assets have appreciated, change in market value, minus the change in the tax obligation associated with that. So our assets have gone up by $12,068. Our personal have only gone up by $100 less because of that change in the personal. So now our total change down here is the change in contributed capital and retained earnings plus the change in our valuation equity, the two sources of wealth change. And in this case, it went up by about $31,000. So if we take our beginning plus our change, that's going to equal what our ending should be. And we can just copy that formula across. Again, if you want to check, just check it there, double click, make sure it's referring to the right things. And we can check that by looking at what our balance sheet says. So plus or equals, go over to the balance sheet, our owner's equity ending for the cost, and we're right on. So far, so good. The balance sheet, market value, the ending, and we're right on. And the farm and family combined ending, right over here, 729, and we are right on. So down here we get all those zeros saying that we are exactly the same. That's what we want to do. So this shows how our wealth changes. We've also shown that all these other statements are fitting together. And that completes creating our financial statements.